Daily stock market update on the 26th of November after the budget and after US Open. Let's start with the budget and then we'll move on to US Open. So the budget in terms of how it affects investors and the stock market, starting with dividend tax rates. So dividend tax rates are about to go up by 2 percentage points. However, if you're holding your stocks within a SIP or ISA, so a tax-free wrapper, my understanding is that makes no difference to you. Here's the implication. I did some of the maths of what that means. Over a 20-year period, if you had 4% yield stocks in a SIP compared to outside a SIP, that makes a 26% difference because of the dividend tax 2% differential. 20 years, inside, outside, not going to make a difference, okay? Over 10 years, it makes an 8% difference, just the way compounding works. So I think the 2%, yes, it hurts if your money's outside of a SIP or ISA. It makes SIPs and ISAs even more attractive, or pension vehicles, tax-free wrappers more attractive. So in a perverse way, the Chancellor is encouraging more tax avoidance through SIPs and ISAs. Secondly, the annual tax-free cash ISA sum is cut from £20,000 to £12,000. Now, don't forget, from 2027, though over 65s are exempt. So lots of exemptions for a start, which makes sense. The over 65s, they might want to hold more cash. But don't forget, that doesn't mean you can't put the full 20,000 into a stocks and shares ISA. That's supposed to be the intent. Of course, what will happen is people will take it out of cash and not put it into a stocks and shares ISA because either they don't know how those work and don't want to invest in them, or simply they'll decide to consume and spend the money. So it's not going to have the intended consequences of boosting the UK stock market suddenly with lots of new investors, the way Margaret Thatcher's privatization of the 1980s did. Who will it make happy? Well, it'll make the brokers happy because they might get more money into stocks and shares and charge more commissions because holding cash didn't really make them much money. It'll make the fund managers happy because they'll have more blind investors putting money into those because sadly, most investors are blind. They just give it to an IFA or a wealth manager. But overall, that in a way, it doesn't really make a difference. Good for us who are investing because it makes no changes. We can still put 20,000 through an ISA as well. Now, here's another one, which is going to, I think, not work out the way the Chancellor intended. New UK listed shares. There's a 3-year stamp duty holiday on newly listed companies. Well, guess what? It's to encourage people to invest in newly listed stocks. Well, here's a problem. As Warren Buffett has rightly said, he doesn't ever invest in IPOs. There's too little data. It's too risky. So it's encouraging riskier stock market behavior, which you might think, well, nothing wrong with that. Let's all have a gamble and a punt. But I don't recommend IPOs. I haven't got enough data on them to want to invest in them. If ever, and I wrote about this in my Financial Times column, for those who don't know who I am yet, author of 18 books on investing, 200 columns in the Financial Times. I wrote in one of those Financial Times columns, the only time I'd look at an IPO would be initial public offering is if the listing price is, say, 100. If the stock opens above it, falls back below it, and then starts going back above it again. Quite complicated. That makes me more interested, not if it opens above and then you buy on day one, because usually they plunge lower. Okay, I did a piece with Emily Maitlis of Newsnight fame on this and Meta and said at the IPO, it's probably going to drop another 50%. And indeed it did. So just be careful about that. I don't think it's a good one for the Chancellor to have dabbled in. Quite frankly, people in the Treasury don't understand the stock market. They understand how to regulate it and tax it. They don't understand how the stock market actually functions in terms of in the real world. In theory, they do. In the real world, they don't. The established investors, higher taxes, as I said, on dividends outside of a pension, savings and property income tax changes, plus frozen income tax thresholds, that overall has raised the tax burden. That could put a drag on consumer demand, consumer sentiment. I don't think it will. I don't think it's going to have enough of an impact. in terms of dragging down the economy. I don't think it's going to have enough impact that it makes the Bank of England increase the likelihood of an interest rate cut. Okay, from what we're seeing here, because corporation tax has been left as it is, and basically income taxes have as well, and national insurance has as well. So there's just not enough here. In fact, it's almost like a scared budget, the kind of budget you would do if you're thinking, oh my God, I'm just going to get into trouble. My ratings are low. I better not do anything, because it looks like I haven't really done anything kind of budget from what I can tell. Certainly from the investment side of things, there's not something right up there where I think, wow, this is amazing. So who might benefit? Now, I don't invest by gambling on legislative changes or sectors. So this is done as information, not as certainly, well, I can't advise you anyway, but for anything more than just information. UK banks and major lenders may well benefit because there wasn't a tax on banks. So Lloyds, NatWest, relief. But that won't be long lasting. It's like saying, oh, things weren't as bad as we thought. That's not a fundamental change in the banking system, making them more profitable, and these companies suddenly look good. So you can see for gamblers who want to go into those banks, they may well do so, but that's not a good enough reason to buy banking stocks. As I said, new listing, new IPOs might be good for them. I don't think it's going to make a difference. I don't think stamp duty was the reason people weren't investing in initial public offerings. I think lack of information and knowledge was. Okay, UK housing related stocks, house building link companies. Some people think there might be a greater demand for housing because interest rates might fall, because the budget was tax raising. So how do you equal that out in terms of economic impact? The Bank of England reduces rates, so counterbalances the impact. I think that's a long shot. It's not good enough reason alone to go into housing stocks. There'd have to be other reasons. Maybe industrial and manufacturing firms will also do better because corporation tax has stayed the same and it's stable. Well, again, it's just so many connections to why. And you can see why the traditional way in which people have tried to pick stocks, oh, the budget did this, so I think I'll go buy an industrial stock. It's such a stupid way. What you should do, as we do on the Great Investments Program, is have the whole list of 10,000 global companies and see which ones are undervalued, producing the most profits and the greatest cash flow. And when you've got that as an example, you can see why you don't rely on man on the pub or just journalistic comment and go into those. Okay, so who are going to be the biggest losers? Well, those investors who are relying on dividends. It's going to be worse off for them. Consumer-facing mid-cap companies, the retail leisure companies, maybe the discretionary spending companies, because people are going to have less disposable income. Or rather, if the Chancellor's correct and the working class have more money, the problem is the working class have less discretionary spending to begin with. So this doesn't really benefit them, because if they get an extra £10 in their pocket a week, a month, that's not enough to move the dial on the broader economy or most of these companies. So it does make a difference there. Real estate property linked, I've already discussed. Savers and cash heavy investors, of course, because of the ISA thing and the fiscal drag, the higher taxes, that could be negative for them. Overall, listen, my Nvidia holdings, my Goldman Sachs, my JP Morgan holdings are not impacted by this. My JP Morgan holdings are up over 40% over the past year. This doesn't impact any of that. So in many ways, this has been completely irrelevant. Am I relieved that corporation tax hasn't gone up? Yes. Am I annoyed it's still at 25% and not at 19%? Yes. I wish it was lower still. So that's where we are with all of that. Now, I want to turn, therefore, to US markets. Before I do, give you some tickers. So Lloyds, NatWest Group, HSBC, I mentioned the banks, relief rally. British American Tobacco, dividend play. BP dividend play. Maybe people will buy more of these within a SIP and ISA now. That's just too speculative. And I don't invest to speculate. I invest for safety, to make money in consistent earners. So it's not a good enough reason to go into the high dividend yielders, Vodafone, Imperial Brands, National Grid, BP, and sell them from outside of a put it into a SIP because of the relative differentials. That's the kind of stuff journalists will write about. It's the kind of BS which gets them eyeballs, but because they've got to write about something. But it's not a bloody good way to invest at all. Not least because dividend chasing, I've written about this in my Financial Times columns, invariably ends up costing you in terms of capital gains. So you think you're getting a good dividend each year. They cut the dividend and the price of the stock falls anyway. You sell it, you're at a capital loss. So it doesn't help you. How about the US markets? Where are we on those? So at the time of recording, futures, not too bad. The futures market is saying that December Fed cut is now around 84%. So it's gone up from being 50-50, which is, again, good for a buoyant market. We might well have a Santa rally and a strong. And gold has surged. I was with a gold refiner out of India with a base in UAE. And now, that's somebody who is an insider. I mean, he really knows the gold market because they're refined, they're vertically integrated, they're global, they've been in the industry for a long while. So I said to him, what the hell's going on? He said to me, Alpesh, you're the expert, you're the financial guru. I said, no. The reason I'm an expert is because I know what I don't know. I said, is this going to keep going up? He thinks 15% higher by February because of Chinese purchasing. He said it's Chinese. I said, what about central banks? He goes, it's Chinese. I said, what about Indian retail? Chinese. What about the futures market? Chinese. He said it's the Chinese buyer, and he would know because he knows where the orders are coming from and he can see all the flows. But you might say, well, 15% higher by February. I'm not that bothered. Thank you very much. Okay. Crypto's at $86,000. It's down 1%. Okay. And as I said, the banks are doing well today in the UK. What else have we got coming out of the macroeconomic side of things? Markets, as I said, are pricing an 85% chance of a Fed cut. Now we've got to the stage where if they don't cut in February, we'll still be win-win because then we'll expect it in January. So we won't be too worried. And if they do cut, we'll still expect maybe a February cut. So we'll be okay with that. There'll be some profit taking if they cut in February. I'll find out next time when the date is in February. On that, crude oil, it's dropped a bit more. US crude is below $60 a barrel. Fantastic for cost of living, etc. And as I said, crypto hasn't fallen enough for me to be interested. There's been some negative stories about Nvidia. The story on Nvidia, let me just explain it to you. Michael Burry has said why he's negative on companies like Nvidia is he thinks that they're changing the depreciation rules. Let me explain what that means. If you've got an asset that you've bought, a bunch of microchips or a data center, and you say to yourself, well, actually, we think this can last longer, so you're only depreciating it at 10% a year, let's say, or 30% a year, or whatever it is, you'd make it because you're making it last longer, then you'll show more profits. So you can show short-term profits by saying that we're only depreciating at a slower rate. Sorry, we're depreciating more. We're knocking more off. I'm going to do a separate video on this. Our costs are up. If your costs are up, your profits are down. Okay. If you do it the other way and you say our costs are down because we're depreciating less, so our costs are down, to this year's allocation is less, our costs are down, your profits are up. So your near-term profits look bigger when you depreciate at a smaller rate. How do you depreciate at a smaller rate? You say it's going to last longer. Okay, you say this table I bought is going to last me 6 years, so I'm only going to depreciate it 1/6 each year. Therefore, my profits this year only need to be decreased by 1/6 of the cost of that. His worry is that's fine. You're bumping up your short-term profitability by playing around with depreciation. But the problem is 3 years in, you say, oh, actually, we're wrong. It's not going to last 6 years. It's only we're going to write off the rest. Sooner or later, the auditor's going to say, bugger me, that's going to have to be written off and your profits are going to collapse. My point is, yes, in maybe years 3 or 4, by then something new will have come along. It doesn't matter. He's saying that's going to matter in 3 to 4 years. He's a bit anally retentive. So he's like, nope, there's going to be a crash. Okay, so that's why he's negative on them and he's talking it up. It only works if he can then vocalize this and force it lower on short-term momentum, because the markets don't discount for 3 to 4 years ahead. They discount for maybe 1 to 2. Okay. And because they're not looking 3 to 4 years ahead, that this table might be written off earlier than we thought, and the asset's worth a lot less than we're claiming. The prices in the near term are not going to move lower. Okay, so whilst they might drop, so Nvidia might drop, I don't know, 10, 14, 15, 20%, that's just general volatility, and it can do that without Michael Burry. If it drops 30%, you're going to have a whole bunch of people buying in, because historically when it's dropped 30% over the last 4 or 5 years, you've had a massive rally upwards. Okay, so I'll do a separate one on Nvidia anyway and make it even clearer in case that wasn't too clear. I need you all to do me a favor if you watched it this far. Remember what I've said. If we get 3,000 viewers a day, I keep doing these. To get those, I need you to save the video. There's a little button you can save, repost it. That's amazing. Or please write a comment that you've liked it. My fragile ego loves comments saying that you've liked it. I'd really appreciate that as well. And what I'd also like you to do is, as I said, repost, like, subscribe, follow. One of the interesting things that's happened recently, I've just crossed 275,000 people on YouTube. So it's as a result of getting the message out to more and more people, and nearly 500,000 on TikTok. Now I want to break those barriers, because the more people who get this, the better. It is a win-win for everyone. The more you share these videos, like, comment, the more people get them, the more likely I keep doing them. You still get them all completely for free every single day. So please do me that little favor. I know I keep saying it. If you'd like to download the book, have a look at campaignforamillion.com. Or alpeshpatel.com/links. All the links are in the bio as well. And I hope you really do like and appreciate all this content. I'm incredibly grateful to you all. Thank you.